Welcome back. When we went away for the break, we told you to figure out how to trade markets that are rising, bull markets, and when you take your profits off the table. And there are three options, and the answer was option C, which was the reversal indicators. When they signal a change of direction, that's one good time to take your profits off the table. Of course, there are other options as well. For instance, if you've reached your target price already, that's another disciplined way of taking your profits off the table. So no easy answers, but just some suggestions and some guidelines to go for. Well, they say that it's near impossible to go against a rising tide, and the same broad logic applies to stocks as well. So let's look at some technically strong stocks and see how they move in a strong market. Obviously, they will be outperforming the market, Doc.
Well, they will most certainly do so, and higher the quality of the stock, higher will be the performance on the upside. What I'm going to do is show you two charts, both of them deemed to be very strong in the market, but showing a little different picture. First is the chart of ITC, wherein the share has been going up, and if you look at it, it's been going up in a very, very nice trend. It is still doing so as we speak, right? When you have stocks like these, then you know the price performance speaks for itself. It's not very difficult to look at the chart and see a rising trend. But where we will know that they are actually doing much better is when we look at indicators. Now I have got two things on here. One I have on is the MACD, which we have spoken about earlier. And the other I have is the DI lines, which is part of the ADX kind of setup. In both of them, you will find that these set of indicators will never get into the weakness area. You know, the MACD will never ever break back lower than 0. And the DI lines will never ever stage a kind of negative crossover as long as the trend remains strong. So we use the indicators to find out the way that the stock is actually outperforming, which is what I mentioned earlier also. Indicators are used to find out what is the strength and what is the kind of set of confirmations that we need about a trend. Now you will find that the trend in this is slightly different. You know, it had this glorious run upward, but then for a very long time, the share has been moving sideways. Now no one says that Hero Honda is a bad stock, but the way you trade Hero Honda as sort of contrasted to ITC would be very, very different. Now if you look at it here, the indicators have actually slipped into the negative, and what we find here is that you would have to trade Hero Honda, whereas you'll have to invest into ITC.
And what we could see for Hero Honda essentially was there was a lot of sideways movement.
Absolutely.
So that's a trader's delight.
It's a trader's delight.
Get your patterns, yes. Get your channels in place, and trade the stock.
But if you just take it as the stock between two stocks, ITC versus Hero Honda, one is clearly bullish. All the signals are very, very clearly bullish. Price trend is bullish. Invest and simply stay long. That's a buy and hold stock. Whereas Hero Honda, which was a buy and hold stock, has ceased to be a buy and hold stock because it's not giving you more money now. You know, it's not making new highs. So
but you don't think it's weakening, and it's not
really weakening. Yeah, it's not weakening. It's just moving sideways. So it's consolidating at the top. Maybe it's deciding whether to go higher or it's all over. That actually remains to be seen.
Right. Okay, so we've spoken about the technically strong stocks in a rising bull market. What about the weaker stocks and maybe also some of the smaller cap stocks which are a little bit weak? Well, they also tend to perform reasonably well in bull markets, but they tend to mostly lag the front runners in terms of timing. So if you're looking at mid cap as a segment, how would you trade that in a bull market?
In a bull market, in the initial stages as well as, let's say, the middle stages, all of them will run together, right? But all these stocks which are of a lower quality, they generally do not perform as much as the good stocks. Now, if you look at the chart of MTNL, which is something which everybody says that it's got a lot of cash on the books and it's not something to be sold, etc. They have the land bank, all sorts of stories, right? But then look at the way it has actually performed. It made a top along with the rest of the market 2008. It gets slammed on a lot more. You know, all these stocks, particularly mid and small caps, they lose 80%, 90% of their value. And then during the pullbacks, now these are the three pullbacks which the market has seen. The market in 2009-10 was right up here. But look, where is this stock? It keeps on making lower tops as the market makes higher tops, as other sectors from telecom makes higher tops. So this will significantly underperform, you know, as the market progresses.
Now, MTNL as a stock, I think, would be unique in itself because it's it's got a weak story to go along with it. So it's in a sense not a dying stock, but you clearly know that the story is over. But there are many stocks in the mid-cap range where the story is still, you know, exists, and it's just a question of timing out or playing out the recession. Would those also attract similar kind of strategies where you just get out of those stocks because they are not performing as well as the front runners?
Yes, they would, because, you know, whether the stock has some sort of merit or not, it still gets classified as a mid or small cap. And then the rising tide lifts all boats type thing. So when the whole tide turns down, all the boats also sink with it. So the mid caps and small caps actually sink a lot more. So whether the stock has some merit or not, it will still sink more than your large cap stock.
So you clearly prefer the front runners?
Yes.
At all points of time.
Okay. That's preferable all the time.
Right. Well, it's interesting to know that while market tops and market bottoms are at the opposite ends of the graph, they essentially represent one similar element, and that is of reversal of sentiment. So let's compare and contrast the two. Very quickly, Doc, you know, 2 or 3 characteristics that stand out for market peaks and troughs.
Well, one of the things is that you will see a lot of volatility at market peaks. You know, all the bars will be much larger. The lower ends will be very, very quiet affairs, very small bars. You'll have very large volumes. You'll have a lot of noise in the market at the tops. Big news, big events. The bottoms are very, very small, quiet affairs. So that is one of the things to look at. The topping patterns and the bottoming pattern will be there, of course. And of course, the mood will be very different. At the peak, everybody's joyous. At the bottom, people are extremely pessimistic. So you need to know this kind of differentiation. It's not rocket science. It's just being plainly logical.
And market bottoms or troughs usually tend to drag on for long periods of time.
Long drawn affairs, whereas you can have fairly swift kind of tops.
Which would be maybe a couple of weeks at the top. Do you see more than that at the top?
It really depends on the quality, like we discussed a little earlier. Quality stocks spend more time at the top, whereas the lower quality ones are up there in a flash and away from it quickly.
Okay, time for a short break. When we come back, we'll tell you about the kind of software that you can use to do technical analysis. We've had a lot of queries on that. We'll give it some time when we come back.